What are REITs? A real estate investment trust is a business that owns, manages, or funds income-producing real estate. REITs, like equity funds, provide an opportunity to invest and allow everyday Americans, not just Wall Street, banks, and hedge funds, to profit from expensive real estate, as well as the ability to reach dividend-based revenue and refund policies, and to help the community grow, thrive, and revitalize. Today's video will talk about everything about REITs, their assets and how it makes monies, why they prefer REITs, etc. So without further ado, let's begin with the video. REITs enable anybody to invest in real estate asset portfolio management in the same way they do in other industries, purchasing individual company stock or via a mutual fund or exchange-traded fund. REIT's stockholders receive a portion of income generated without having to purchase, manage, or finance real estate. Roughly 145 million Americans have REITs investments in their 401ks, IRAs, pension plans, and other assets. How do REITs make money? Most REITs follow a straightforward business model by renting space and rent collections on its real estate. The business generates money, which is then distributed to stockholders of dividends. As a result, REITs must distribute at least 90% of their tax liability to shareholders, with the majority distributing 100%. Shareholders then pay dividends, income taxes. MREITs, also known as mortgage REITs, do not directly own real estate. Rather, they finance all the real estate and generate money from the interest over such investments. What assets do REITs own? REITs of all kinds own over $3.5 trillion in gross assets in the United States, with public REITs having held roughly $2.5 trillion in assets, representing over 500,000 properties. In addition, the equity market capitalizations of REITs listed in the United States surpasses $1.35 trillion. REITs invest in various real estate types of property, such as offices, apartment buildings, storage facilities, retail centers, medical facilities, data centers, cell towers, infrastructure, and hotels. Most REITs specialize in one type of property, but some have a diverse portfolio of properties. REITs' performance in the past. When compared to the broader stock market, bonds, and other assets, REITs track history of reliable and going to grow dividends, incorporated with long-term capital growth with the increment in stock price, has served captivating total return achievements for most periods until the past 45 years. REITs are publicly traded, professionally run businesses that manage the business owners intending to maximize shareholder value. This includes positioning their characteristics to captivate tenants and make rental income, as well as managing the property portfolios and purchasing and selling assets to build value over long-term real estate cycles. Why invest in REITs? REITs have traditionally given competitive annual returns through high, consistent dividend income and long-term capital growth. In addition, because of their weekly correlations with other assets, they are an excellent portfolio diversifier that can help to reduce overall portfolio risk while increasing returns. These are the characteristics of real estate investment trusts. So, this was all about REITs. Let us know your views in the comments below.